afternoon, and welcome to Blucora's investor conference call to discuss third quarter results. Before we begin, I'd like to remind you that during the course of this call, Blucora representatives will make forward-looking statements, including but not limited to statements regarding Blucora's expectations about its products and services, outlook for the future of our business and growth initiatives, and anticipated financial performance for the fourth quarter. Other statements that refer to our beliefs, plans, expectations, or intentions, which may be made in response to questions, are also forward-looking statements for purposes of the safe harbor provided by the Private Securities Litigation Reform Act. Because these statements pertain to future events, they are subject to various risks and uncertainties, and actual results could differ materially from our current expectations and beliefs. Factors that could cause or contribute to such differences include, but are not limited to, the risks and other factors discussed in Blucora's most recent quarterly report on Form 10-Q, on file with the Securities and Exchange Commission. Blucora assumes no obligation to update any forward-looking statement which speak only as of the date the statement is made. In addition, during this call, our management will discuss GAAP and non-GAAP financial measures. In the press release, which has been posted on our website and filed with the SEC on Form 8-K, we present GAAP and non-GAAP results, along with reconciliation tables and the reasons for our presentation of non-GAAP information. We have also provided supplemental financial information to our results in the Investor Relations section of our corporate website at www.blucora.com and filed with the SEC on Form 8-K. Now I'll turn the call over to Bill Ruckelshaus. Following his comments, Emans will review third quarter results and fourth quarter outlook. Then we'll open up the call to your questions.
Thanks, Stacy, and good afternoon. Our progress at Blucora continues. Ongoing challenges at InfoSpace this year underscore the importance of our multi-year strategy to build value through diversifying acquisitions. Our transformation centers on two fundamental beliefs. First, digital migration trends create opportunities for profitable, disruptive businesses, and in most vertical markets, the shakeouts are just beginning. Second, Blucora can acquire quality digital businesses, position them for growth, and operate them effectively inside a tax-efficient parent company. We remain confident that continued execution of this diversification strategy will result in compelling value creation for our shareholders. Now to our performance in the quarter and year to date. In search and content, we continue to navigate headwinds at InfoSpace. While search results in the quarter were in line, many of the transitions discussed this year, including the removal of Google from mobile, continue to weigh heavily. In mid-August, our distribution network showed further weakness. Evolving search partner policies impacted our network in the quarter and challenged the ability of our partners to profitably promote our meta-search offering. We are working with partners to adapt, and while some are finding opportunities to grow, overall the network is more pressured, and we now expect transitions to continue to play out in future quarters. On the owned and operated side, How Stuff Works is largely transitioned and integrated. The team is focused on accelerating content creation and distribution to grow audience and drive engagement. How Stuff Works is a brand-safe, highly contextual property with a large, intent-driven audience. We look forward to more progress at How Stuff Works in 2015. At our owned and operated meta-search sites, we are limiting marketing spend pending efficiency improvements. Meta-search as a core offering continues to be relevant, and we are adding non-search content to the product to improve engagement and build audience. These changes will take time, and we expect further pressures in owned and operated search in the near term. Overall, search and content remains challenged. Under the new leadership of Peter Mansour, InfoSpace is responding in a couple of important ways. First, we are emphasizing opportunities at How Stuff Works and testing new models that can offer more stability while leveraging core strengths in content distribution, traffic acquisition, and partner management. Second, InfoSpace is resizing its team to reduce costs and create a more efficient organization. Decisions like this are not easy, but they are necessary during our transition. There is much work to be done and many opportunities to exploit at InfoSpace, and we are confident of the team's ability to respond and move in new directions. We look forward to providing an update in February. Turning to e-commerce. Monoprice performed to guidance in the quarter, but top-line growth, 3% year over year, is below our expectations for this business. As previously noted, Monoprice is under the new leadership of Bernard Luthi, who is strengthening the product lineup and re-energizing loyal customers. In the short time aboard, Bernard has implemented changes to core systems and processes, redoubled commitment to new product introductions, and added seasoned executives to the leadership team. These initiatives will pay off in 2015 and beyond in the form of faster time to market with new compelling products, improved site experience, and enhanced customer monetization. Monoprice products continue to draw rave reviews. In the third quarter, Monoprice lightning cables, battery packs, and chargers were featured in numerous head-to-head comparisons and consistently cited for high quality and best value. Overall, we are encouraged by the progress that the Monoprice team has made this quarter, and we continue to believe in their three-part formula: quality products, fair prices, and a profitable growing business. Moving to tax preparation. With new product features and a compelling value proposition, TaxAct is readying for another successful tax season. Consumers continue to shift to DIY, driven by improved software, mobile access, enhanced service and content, and favorable demographic shifts in the filer population. We believe overall filers will grow about 1% next year and expect DIY units to grow in the 3 to 5% range. Our goals continue to center around maintaining and building upon our share position in DIY and bringing more value to our customers in the process. This off-season, the team focused efforts on core product and mobile enhancements, adding ways for do-it-yourself customers to meet filing requirements quickly, easily, and cost-effectively. TaxAct recently launched a multi-year customer experience initiative designed to emphasize simplicity, speed, and accessibility throughout its applications. This season, they introduced upgraded interface and account features that streamline steps for consumers to manage returns and related documentation. The new UI will also integrate with TaxAct's mobile apps, such as Donation Assistant, that tracks charitable donations throughout the year. Last month, the team launched our 2014 Federal DIY and Business Editions, empowering customers to preview their 2014 filings and identify year-end savings opportunities. We also launched our 2014 Federal Prep Solution, which features improved import capabilities, added organization tools, and new reports to assist with client year-end tax strategies. Joanne Kinsel and the team continue to tackle opportunities in DIY and assisted preparation, and we look forward to another solid season next year. Before I turn it over to Eric for more on our performance, let me touch briefly on capital allocation. M&A continues to be an opportunity for us and as we further diversify and grow. Market conditions must be right to allow us to acquire a quality business in a structure that makes sense for shareholders. We are focused in the right areas and remain vigilant and patient at the same time. Our execution and discipline here can be an added catalyst in 2015 for Blucora. With that, I'll turn the call over to Eric.
Consolidated revenue for the third quarter was $114.9 million and within our guidance range. Adjusted EBITDA was $10.7 million and exceeded the high end of our guidance. Non-GAAP net income was $6.5 million or 15 cents per diluted share, and GAAP net loss was $2.2 million, or a loss per share of 5 cents. We exited the third quarter with cash equivalents, and short-term investments of $280.4 million and net cash of $15.8 million. Now let's walk through the third quarter segment performance, beginning with Search and Content. The Search and Content segment again experienced downward pressure in the third quarter. Revenue for the quarter was $74.4 million, down 7% sequentially, and segment income was $12.7 million, down 9% sequentially. Revenue was above the low end of our expectation, while segment margin was at the high end of our expectation, as the team worked to maximize profitability, including cutting of discretionary costs. Drivers of the revenue performance were as follows. First, in mid-August, owned and operated experienced a decrease in revenue earned for traffic without a commensurate decrease in marketing costs. As a result, we pulled back marketing spend, further negatively impacting revenue. The deterioration has been correlated to volatility in quality scores and changes in the manner in which these scores are applied, both of which are proprietary and controlled by our search engine customers. We are working to adapt, but our ability to grow owned and operated is currently limited. Second, distribution partner revenue was pressured by changes to and/or enforcement of search engine customer policies. These changes and enforcement actions have increased in frequency, and during the back half of the quarter have impacted some of our larger and more tenured partners. In addition, these changes and enforcement actions are contributing to ongoing challenges of bringing new partners into the network. As a result, we are expecting further sequential declines in the fourth quarter. Lastly, we experienced distribution partner traffic losses to competitors. These losses accounted for approximately $2.2 million, or 30% of the sequential decline of our quarterly distribution revenue. These losses are attributed to increased competition in the space, including competition from our search engine customers. Turning to the fourth quarter, as Bill mentioned, we are taking actions to pivot the business through redeploying of existing resources. Additionally, we have implemented cost reductions that will eliminate approximately $2.5 million of annual costs. Our outlook for the fourth quarter is as follows: revenue of $56 to $65 million and segment income of $6.7 to $9.5 million. Please note our segment income range includes one-time charges of $1 million associated with the aforementioned cost reductions. In summary, the search and content business is in a period of transition that is expected to extend into 2015. Additional volatility should be expected. In short, the business is likely to get worse before it gets better, and thus our ability to provide guidance beyond the following quarter is extremely limited. With that being said, we believe Peter and the team are well positioned to navigate through these challenges and transform the business. With that, let's move to e-commerce. Revenue for the third quarter was $38 million, and segment income was $3.3 million, for a segment margin of approximately 9%. Revenue on a pro forma basis was up approximately 3% versus the prior year, and segment margin was down approximately 250 basis points, both in line with expectations. Year-on-year revenue growth reflects an 8% increase in average order value, offset by a 5% decline in order volume. While we are making good progress, we continue to be conservative in our forward expectations, and for the fourth quarter, we expect revenue of $39.5 to $41 million and segment income margins in the mid-8% to low 9% range. Turning to the tax preparation segment, revenue for the quarter was $2.5 million, and we recorded a segment loss of $1.9 million. We are increasing our 2014 full-year revenue expectations by $500,000 from $103.5 to $104 million, and expect segment margin of approximately 47.5%. Looking forward to the next tax season, we expect revenue for the first half of 2015 of $108 to $110 million, and segment income margin of 55 to 56%. Moving to unallocated corporate expenses, third quarter came in at $3.5 million, and we expect fourth quarter costs of approximately $4 million, mainly driven by an expected increase in professional services. Closing with our consolidated fourth quarter expectations, we expect consolidated revenue between $97.5 and $108.5 million, adjusted EBITDA between $2.4 and $6.4 million, non-GAAP net loss of $1.5 million or a 4-cent loss per share to income of $2.5 million or 6 cents per diluted share, and a GAAP net loss of $9.1 to $6.4 million or 22 to 16 cent loss per share. With that, let's turn the call over to the operator and we'll take your questions.